So we've all seen the news in the past few days that US oil is negative, which means somebody will pay you to get the oil off their hands. In this video, we're going to talk about what it actually means, and spoiler alert, that doesn't mean that somebody will pay you to fill up your car. We'll talk about what futures are, what's WTI oil, and USO ETF, which is largely responsible to what's going on with the oil right now. So let's firstly talk about what future contracts are, and we'll use oil as an example because this is the question we're trying to answer. And in simplistic terms, there are three players: buyers, future price, and the sellers. For this example, we're going to use an airline company, and again, to keep it simple, we're going to equate jet fuel to oil. So as a buyer, as an airline company, of course, it's in my best interest to keep the lowest price possible, because probably jet fuel is one of the bigger items on my profit and loss statement. So the cheaper I can get it, the more profitable I am. At the same time, even if the price for oil right now is super low, I can't just buy it like year ahead of time or years ahead of time, because I have storage costs, I have transportation costs, I gotta keep it somewhere. Maybe jet fuel gets stale, so you can't just get it forever. You have to keep buying it at certain times. So you have to optimize the storage costs. And on top of that, demand varies by the season. So for example, in January, there's not as many vacations, there's not as many flights, I don't need as much fuel. But in the summer, it's vice versa. A lot of vacations, so I'll need more fuel, and probably my competitors at the same time will need more fuel, which might raise the price for oil. So on the flip side here, we have sellers, which is, in this example, is a refinery, and they want the highest price possible for gas. So for example, right now, if the gas is really cheap, they would ideally like to keep it and wait till the price goes up. However, they run into the same issue of optimizing the storage costs, because they don't have unlimited storage capacity. So sooner or later, they're just gonna ship that oil. And they also have to deal with demand. If there is not a lot of demand, the price probably goes down. If there is a lot of demand, the price goes up, but they don't necessarily have enough oil to sell for that higher price if they didn't account for that. Which brings us to the future price. At some point in the future, at which point neither buyer nor seller don't know exactly what the price will be or what the quantity will be needed by either party. And the price usually is influenced by basic economics of supply and demand. So for example, if it's limited supply, for example, it was a hurricane in Texas, the price is gonna go up. If there's too much supply, like what's going on right now, the price is gonna drop way down. And the same with demand. There is no demand right now because of COVID-19, so the price goes down. And if all of a sudden we get opened up and everybody wants to travel, the demand is gonna go up, so the price is gonna go up. So to eliminate this uncertainty for both sellers and buyers, futures contracts exist. And what happens is both buyers and sellers agree to buy or sell this commodity, which is oil in our case, for a set price. So for example, in September 2020, both airline company and the refinery can agree to purchase a certain amount of jet fuel or oil for $40 a barrel. So say September came and the actual market price is $35. So what it means is that the buyers, they're kind of losing here because they're buying it for $5 extra than the market price. Probably not all of their jet fuel comes from future contracts. So maybe half of it they would have to pay the premium, and then half of it they will buy for the market price. On terms of the sellers, it's vice versa. They're kind of winning it because some of that supply they're gonna sell for $40 instead of the market price of $35. So both buyers and sellers agreeing to this price and the quantity in the future is really a hedge strategy to reduce the risk of fluctuating prices and trying to keep it consistent. It's also really a strategy of optimizing storage costs, because If the storage was unlimited, then the refinery would just keep the oil when the oil is cheap and will only sell it when it's expensive, and buyers would only buy oil when it's really cheap, and when it's expensive they'll just use their storage. So of course in the real world everything is a bit more complicated than in a simplistic model, which brings me to this next slide. So for this example, let's say it is close to September 2020 and current market price is $60, and there's no reasons to expect it for it to go down, maybe just go up. So if I had a future contract for $40 and I actually didn't need the jet fuel because perhaps I'm not an airline company, I could sell it to somebody who actually needs the oil for maybe $59 because it's still $1 cheaper than buying it at market price of $60. So constantly changing price and ability to lock the future price with a quantity gives the burst to speculators who think they know better than the market, they know where the price is going to go, and they can make money off that. And the key part is the speculators don't actually need the commodity, so it's just person like myself who can play it. I don't actually need the jet fuel. So if I buy the futures and then I don't sell them to anybody, at some point I'll actually have to take a delivery of the oil. And I think the minimum buy is 1,000 barrels. So if I bought the future and I didn't sell it to anybody, at some point, say September 2020, I would have to take a delivery of at least 1,000 barrels of oil. So to add a layer of complexity to what's going on in the markets, not only we have individual speculators, we have all of those speculators packaged up into a neat package in ETF, which is electronically traded funds. And ETFs you can buy through your regular brokerage account, through your bank account. So you get the exposure, and a lot of people want it, to commodity without an actual commodity account, because for that you need a special futures broker and you need to understand each individual kind of packages, and you also run a risk of receiving the delivery of the goods. And those ETFs get traded like a regular stock. You get the intraday pricing, you can buy it and sell it at all times, which it makes it very convenient for regular people to play in the commodity market or just have it as part of their portfolio. Which finally brings me to the current situation that explains why the oil prices are negative. So on the left hand side we have a buyer, US Oil Fund, which is an ETF, so that's the thing that packages up all of those futures in a neat package so you and I can easily trade them. On the right hand side we have WTI, which is a producer of oil, and it's a West Texas intermediate oil. It accounts for almost 1/3 of all oil produced in the world, and by the name of it, it's made in Texas. So if you would have bought futures from WTI, most of the delivery and like price settlement would have to be in the city called Cushing, Ohio. So what happens right now is this ETF, USO, bought 30% of all futures for May from WTI. What it means is that unless they sell those futures to somebody else that needs it, because this ETF actually doesn't run anything that requires the oil, unless they sell it, they have to take physical delivery of 30% of 1/3 of world oil in May. And of course they don't need it. And the problem in the city of Cushing, Ohio, because of the COVID-19 and really no demand for oil, the city is almost at a capacity, so they can't actually receive the oil. And that's the situation. So what can USO do right now? They can basically pay somebody to take that oil off their hands, because otherwise they'd have to pay premium to Ohio to store it or find another storage facility, which is scarce right now. And this is what happened specifically for May, for this specific fund, for this specific oil, not for the rest of the oil in the world. The price went down for the first time to be negative. So what does negative price for oil really mean? So first of all, it's a storage issue. If there was a little bit more storage capacity in Cushing, Ohio, this situation wouldn't have happened, or if there was more storage in the world. That doesn't mean that in a long term the demand for oil went way down. Sooner or later this oil will be needed. Also, if you Google yourself oil futures, you're probably not going to see the negative numbers, and it's because 2/3 of the world oil is actually not WTI, it's Brent crude, and that would be Russia, Venezuela, Saudi Arabia, and those guys don't have storage issues or transportation issues right now. They also, because they've seen what's going on, they made a pact to reduce the supply. So the problem was why so much oil was stored, because there was some sort of a price war going on between Russia and Saudi Arabia and Texas, and they've been producing oil like crazy that nobody really needs. Now they stopped the producing of the oil, so this pressure on the price from the supply is gonna go away. And of course, if you can find a place to store oil till, like, say September, when the supply will be reduced and finally probably we're gonna open up the economy at least in some way from COVID-19 and everybody would need this oil, you will sell it for more money than right now, because right now you actually get paid to take that oil.